All right, so good evening, everybody, and it gives me immense pleasure to welcome you all to today's webinar because we have a very special luminary with us today from the world of investments, Mr. Saurabh Mukherjea. This webinar is being conducted by the Indian Institute of Quantitative Finance. We are involved in education and training in the fields of quantitative finance, algorithmic trading, in risk management as well. So of course, Saurabh is quite well known and needs no introduction, but just a little bit about him. Saurabh Mukherjea is a founder and chief investment officer of Marcellus Investment Managers. Mr. Mukherjea earned a BSc in economics with first class honors, as well as an MSc in economics as well, with distinction in both micro and macroeconomics from the London School of Economics, one of the most prestigious institutes we know of in the field. He has been rated as the leading equity strategist on more than one occasion by Asia Money polls. And prior to setting up Marcellus, Mr. Mukherjea was the CEO of Ambit Capital. He has also been a part of various committees of the Securities and Exchange Board of India and has also written several enjoyable books. And I stress on the word enjoyable because I'm sure the reader would really have fun reading it, apart from the knowledge that one would actually draw. Some of those books are Gurus of Chaos, The Unusual Billionaires, Coffee Can Investing. This is something particularly which I found very helpful, and Diamonds in the Dust, among many. So I'm sure you will find his inputs very enriching. But before I hand it over to Mr. Mukherjea, I kindly note that to maintain the smooth flow of the session, the speaking rights actually would not be enabled to participants. However, we would like this to be very interactive, and we would request you to post all your questions in the chat window, and we'll try to address as many of them as possible. All right. So without much ado, I will now hand it over to Mr. Mukherjea. Yeah. So Saurabh, I'll make you the presenter.
Thank you very much. Thanks, Gilbert. Thank you very much to IIQF for hosting me. I will start with a disclaimer. I really have no idea about quantitative finance, right? So I'm very gratified, very grateful that IIQF invited me. But quant finance in the classical sense of the word, right? Factor investing and the use of mathematical and statistical techniques to invest money is not something which either I or my colleagues in Marcellus specialize in. What we do is we do apply a degree of numbers and quantification to our work. I'll talk about that. But classical quant finance, in the sense of Wilmot on finance, or what say people in American universities do, factor investing and so on. We really don't know much about that. I'm sure that is powerful in its own way. I'm sure all of you know about the success that Renaissance Technologies has had over the last 50 years, right? Jim Simons and team have used maths and physics and abstract algebra to make insane sums of money. We are trying our best to figure out what people like Jim Simons have figured out 50 years ago, but I have to confess, we simply don't have that sort of mental firepower. So we do what we can in India. So I'll talk about our style of investing. I'll then give you the book references which Edelbert just referred to. There's three of us who started the business in Marcellus, and we've been working together now over the last 18 years. And really the genesis of our use of quantitative techniques was this, right? Was fraud. So 2008 May, I moved to India, and because we wanted to understand how money is stolen in India, we spent the first couple of years reading annual reports and meeting the companies whose annual reports looked palpably fudged, right? And in these meetings, we sort of realized that because the prevalence of accounting fraud is so widespread in India, and because the prevalence of accounting fraud is so widespread, unless any investor really uses a core set of quantitative techniques, a core set of finance ratios to weed out corrupt companies, unless an investor weeds out corrupt companies, their returns will get damaged by fraud. And one simple way to understand how significant accounting fraud is in India, if you notice, if you look at Nifty's long-term returns or Sensex's long-term returns, they're around 12%. Whereas nominal GDP growth in India over the last 20 years has actually been north of 12%, right? So 7%, 8% real GDP growth at 4-5% inflation, right? Nominal GDP growth over the last 20 years has been actually more like 13-14%. And yet the index, remember, Nifty is supposed to be India's very best companies. Rather than growing faster than nominal GDP, the Nifty grows slower than nominal GDP, and that's a sure short sign. That's a sure short sign that large listed entities are fudging their numbers. In contrast, we just want to understand how glaring an anomaly this is. In contrast, if you look at S&P 500 last 20-year returns, they'll be 12-13% in dollar terms. American nominal GDP growth over that period would be barely 7-8%, right? So the S&P 500 does what we expect it to, which is it's the finest collection of what America has to offer, and therefore it beats American GDP. The Nifty doesn't do that, and that's one straightforward way to understand the incidence of accounting fraud. And when we moved to India 14 years ago, and even to this day, I find it very strange. I find it very strange that fund managers don't have a basic forensic accounting toolkit, a basic set of forensic accounting ratios, which helps them identify fraud. And therefore, to my mind, any discerning investor, the first step really has to be what I'm showing you on the screen. Edelbert, you can see my screen, right? Forensic accounting helps avoid common pitfalls. You can see the screen?
Yes, Saurabh. It's visible.
So the way this works is we use around a dozen or so forensic accounting ratios. The full list is given in diamonds in the dust. First 150 pages, we've given you the entire accounting toolkit, all the ratios, worked examples of how we detected real fraudsters in real time. Honestly, barring the phone numbers of the fraudsters, pretty much everything else we've given on around 10 corrupt companies in the country, and we detected these real time, and to this day we continue detecting fraudsters real time, just that for obvious reasons we don't go out shouting in broadcast media their names. We just quietly avoid them, and eventually they blow up, right? So for example, I've shown you a bunch of these ratios on the on the top left of the screen, yes, over time we have hired people who have math stats qualification, so that they take these accounting ratios and they apply it far more rigorously than say a non-mathematician like me can. So for example, if you take a ratio like CFO to EBITDA, incredibly powerful forensic ratio. In a variety of settings, I've seen CFO EBITDA juice up returns for us, and this is nothing but CFO EBITDA is a simpler way to understand working capital, right? Because the gap between operating profit and operating cash flow, the gap between operating profit, which is EBITDA, and operating cash flow is obviously the working capital cycle. If you and I either know the working capital cycle from, say, being familiar with the industry, or you simply take 5 large companies in that sector, take the last 10 years of their accounts, calculate their CFO EBITDA, you know what the norm should be, what the base CFO EBITDA should be, and therefore, if you have deviance from that, you know there's a problem. And as we speak, I would submit to you that, say, in the pharma sector, a prominent Hyderabad-based pharma company has a deviance from this. They've had the deviance for a while, and I've long waited for them to suffer because of their accounting problems. But the deviance is becoming more pronounced, and I think that Hyderabad-based pharma company sooner rather than later will come to grief on account of that. And then we've done this several times, right? On a variety of companies, you spot the problem and you avoid it, and sooner rather than later they blow up. Typically, these blow ups, companies that we spot having dodgy accounting, typically these blow ups happen when liquidity tightens. Right? When liquidity tightens, the bond market, the banking system, the stock market liquidity dries up. The naughty company's ability to keep budging the accounts stops, and in very quickly you'll have 3-4 major blow ups, right? Recent example being, if you think about it, right? Liquidity was super flush in 2017 in the wake of Demon, which was 2016. Liquidity was super flush in 2017, and even in, I remember, June 2017, we figured out a whole bunch of lenders who were doing corrupt accounting. And it doesn't take a genius. Honestly, once you sort of build a basic quant framework, you can see very quickly who the corrupt lenders were. And we just said, well, as soon as liquidity starts tightening, you'll see these lenders blow up. And sure enough, August 2018, I think DHFL's problems began. Very soon thereafter, Yes Bank ka problem aa gaya. Then very soon thereafter, ILFS problems kicked in. Very soon thereafter, that PMC Bank in Bombay problem kicked in, right? And so within the space of 9 or 10 relatively prominent lenders came to grief, right? And this will happen again. This is the nature of markets, right? So what we do is, if you want to understand the quant methodology here, you've got, say, a dozen such accounting signals, such as CFO to EBITDA. We have a way of coding these signals in terms of will a red light come on, whether an orange light comes on, or a green light comes on. A green light means that this company is in the top 6 deciles, and really no reason to worry. If you look at the chart on the right, a green light on these metrics means the company is in the zone of quality, and in our model, there is no penalty given to that company. An amber light means zone 7, D7, D8, decile 7, decile 8, and a red light obviously means at the bottom 2 deciles, 9 and 10, right? Typically in our work, we have found it incredibly useful to completely stay clear of D7, 8, 9, 10. And we're doing these deciles basis the last 6 years of published financials, which means every year when the annual reports come out, we update the model. And we update the 7, 8, 9, 10. And every year, our analysts are told, look at the updated model. Is there anything in our portfolio which is in 7, 8, 9, 10? If there is, let's identify what issues are kicking in the accounts. Sit down with management, tough chat on ye issues hai, aap kya kar rahe ho? And if management doesn't resolve those accounting issues, we are out of there, right? So straightforward, brutal sort of clinical work, right? This is not, there's no emotions involved here. We have if we invested in you because your accounting was good, and over time it has deteriorated, our bond system will pick it up. We will then quiz you, probe you, haul you over the coals on that. And if you're not able to explain to us why the accounting ratios, the ratios on the top left of the screen have deteriorated, we will be out of there. And then you and your shareholders and your family can figure out what to do with the rest of your lives. So this is the first part of what we do, and you can see on the bottom left of the screen. If all you and I did in India was this, we just invested in the zone of quality, the top 60% on accounting. That itself would allow us to beat the rest of the market by a good 7 percentage points, right? So quality, as we call it, quality wins big. If you take a long-term time period, if you take a 5, 6, 7 year time period, the better quality companies give you better returns than the rest. Interestingly, though, one very interesting finding which keeps cropping up in many different areas of our analysis, and this is the sort of more conventional quant work that sort of American funds do, but I don't think is yet. Meet for dinner, and in one such dinner in 2014, Sanjay Bhattacharya, who's been a source of tremendous support and insight and guidance, Sanjay Bhattacharya suggested that we read a paper by Rob Kirby called Coffee Can Investing. So on the taxi ride home, I read Kirby's paper. Anybody can read it. It's on Google. Just Google it, and you'll find it on the internet. And Kirby's insight remains very simple. The great man passed away a few years ago, unfortunately, but his insight remains very simple and very powerful, which is buy a bunch of great stocks and sit tight. Right? There's no need to trade. There's no need to time the market, look at PE multiples, right? The usual sort of nonsense that you hear in the stock market. None of that actually is any use. Buy a bunch of great companies and hold on for long periods of time. And it's a beautifully written paper which brings out the power of why holding a bunch of great companies over long periods of time will outperform almost any strategy you and I can come up with. You can hear me now, Nitish?
Yes, absolutely fine.
So the question that then arose was, how do you identify? How do I identify? How do we identify a bunch of great stocks, right? And we looked around for an answer. Uh, 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 we ended up, obviously reading. We read extensively, like any other investor. We read an enormous amount of material. And I remember listening to Bharat Shahji, who was and remains at ASK, him speaking at a round table for investors at the Taj in Colaba. This is now fag end of 2014, and he spoke about how in his investing he uses ROCE, return on capital employed, and revenue growth as two critical metrics. ROCE, he explained beautifully, measures the strength, the depth of the moat, and revenue growth measures the ability of the franchise to compound, right? So immediately the thought struck us that we should try to see if we can use ROCE and rev growth as ways to capture the definition of what is a good franchise, right? And we tried various things. 2015, we hit upon the fact that if all you and I did was look for franchises which deliver a pre-tax ROC above 15%, 10 years in a row, right? 10 years, every year, 10 years in a row. And they combine that ROCE of 15% minimum with double-digit rev growth every year. If you can combine ROCE above 15 and double-digit rev growth, do this for 10 years, your firstly astonishing finding is many companies who do this, right? Over any 10-year rolling period, ROCE above 15 and double-digit rev growth, only 20, and actually 22 is a generous number. Typically assume 15 companies are able to do this. But if you invest in those 15 and sit tight for the next 10 years, you beat the Sensex or Nifty black and blue, right? They're no longer in the picture. Sensex, Nifty become irrelevant. And that obviously led to two books. The first was the strategy book, Unusual Billionaires, 2016. We published Unusual Billionaires. It's now in, I think, third or fourth edition. You can find it on Amazon. And then subsequently, the book that Edelwood mentioned in 2018, we wrote Coffee Can Investing, about basically drawing inspiration from Kirby, how you and I in India can use this very simple quant technique, if you want to call it that. I call it Pythagoras theorem. Very simple, very intuitive quant technique by a bunch of companies who passed these two very seemingly trivial but actually very demanding tests. ROCE above 15, double-digit rev growth, hold them for 10 years, and compound away to glory. Right. So in our work in Marcellus, this is now the second layer of work. So this is we call it the capital allocation filter. And as you see in the box, the blue box in the top right, we use this filter, and you can see the results in the chart on the left, in the red box on the bottom right. Very strong outperformance, and you can find in all of my books, including Diamonds in the Dust, worked examples of why of this and why this is such a powerful way to compound wealth, right? So step one was accounting. Step two was capital allocation using the Kirby techniques. These two steps, right, leave us with no more than 30-40 stocks to focus on, right? And it's only in the final layer of our work that we actually do qualitative work, right? The final layer is, but I was saying that it's only in this third stage of work. Step one was forensics, step two was capital allocation. These are entirely quant driven processes. The first two steps leave us with around 30 stocks. It's only in this final step, when we go from 30 stocks to a 15 stock portfolio, that we use qualitative work. But even the qualitative work is actually in a way quantitative. Why is that? Right? When you or I invest in a stock, we are not actually second guessing the share price. A lot of people mistakenly assume that their job is to estimate the intrinsic value of the firm and then check that the intrinsic value is below the current shares, above the current share price, and under various notions they call this value investing, right? Some people call it margin of safety. There's all sorts of mumbo jumbo in the world around this. Effectively, your job is actually far simpler in one way but trickier in another. What you and I have to do before we invest is, we have to say that, look, today this is a great company. That's why it's made it so far in our process, right? Its books are clean, its capital allocation has been great. This is a successful company today. But how long will it remain a successful company? For example, will Titan, one of our largest holdings, will Titan continue to grow free cash flows at 30%, which is what it has done for the last 20 years? Will Titan grow free cash flows at 30% for another 5 years, another 15 years, or another 25 years, right? And the answer, obviously, in terms of Titan's valuation, is hugely dependent on this call. Will Titan compound free cash flows for the next 5, 15, or 25 years, right? That answer is basically the homework exercise that an investor in Titan has, or an investor in Asian Paints has, or an investor in Pidilite has, or an investor in GMM Pfaudler has, and so on, right? So the investor's job is to actually figure out the longevity of the franchise, which is why we call this method of analyzing company longevity analysis, right? The easy part of the analysis is the left-hand side of this flow chart. This checks Titan's products are selling, say, roughly at a 30% price premium, which is roughly accurate, actually. Tanish's making charges are consistently 30% higher than any other jeweler. And then the hard part begins. The question that we then ask the team is, if Tanish consistently charges 30% higher than any other jeweler, why is it that not a single customer leaves Tanish, right? What is the secret sauce, right? If HDFC Bank consistently pays lower cost of funds to its CASA customers, why don't HDFC Bank, right? Or if GMM Pfaudler is consistently charging a 30% premium for its glass line reactors, why don't customers leave GMM, right? This then becomes the hard question to answer. And that's where the research moves into the right-hand side of the flow chart. So the left-hand side is the kind of statement of the obvious in a way, which is identify the price premium, make sure that the price premium exists, identify the size of it, and then we get into kis liye this company can charge a price premium. So we break this analysis, the kind of root cause of the price premium. Why is it? What is a great franchise fundamentally? A great franchise is a company that charges prices 20 to 40% higher than the competition consistently, without the competition being able to do anything about the great company's market share. That is fundamentally a great company. I'm charging you higher prices, but every customer wants to be me only. They want to pay me the higher price. They don't want to go to anybody else. Right? Why is that? And we tell our analysts, break the analysis now into two parts and quantify both parts. Right? So the first part is lethargy. The second part is succession planning. Right? Think of lethargy as a measure of the company's drive, energy, determination to consistently improve the franchise, improve working capital cycles, asset turns, improve business processes, keep launching new products and services, keep bringing to the market disruptive initiatives that completely destroy the industry, right? Think of it as a measure of that. We score that. We measure it using a bunch of parameters and we score that. So in our research team, there's a score for Pidilite's lethargy, Asian Paints' lethargy, Astral Poly's lethargy, so that we can compare various companies. We can compare an HDFC Bank with a GMM Pfaudler on lethargy, and they're measured on a similar set of qualitative and quantitative characters. So lethargy becomes a score, and succession planning. To what extent is the current management team hiring, training, grooming the next generation management team, right? Very few companies do this in India properly. So this becomes almost like the factor. Succession planning becomes the factor which separates the men from the boys, right? The women from the girls. Very few companies in India are able to consistently hire top quality talent, train them, groom them, and over a 20-year period, turn them into the CEO of the company, right? बहुत rare है India में. We again score this. We again score succession planning on a bunch of metrics. The result of that is something along the lines of this. We are able to compare companies with each other on their scores. On moat, I told you what moat means. It's the price premium. We're able to compare them on lethargy. I explained to you what that is: drive, determination, the ability to consistently improve the franchise, and thirdly, succession planning. All of these scores. Any questions that you guys have?
Yes, there are a few questions that the participants have. So again, if you want to take the questions, then actually I can collect the questions for you.
Yeah, if you could, is there somewhere I can see them on the screen? Happy to read it and try and answer them.
I'll collect the questions for you. Don't worry.
Okay.
So the first question is from Amit, and though you have actually dwelled upon this topic a little bit, but again, if you want to elaborate anything more, so he asks how to read annual report like Marcellus managers. So anything you want to add to what you already mentioned?
I think there's two ways to go about it. First is if you have the inclination and the time, could become a chartered accountant or a CFA, or at the very least, there are several online courses actually. Perhaps IIQF also offers them. There are online courses which will teach you how to read financial statements. Right? To my mind, Nitish, you can hear me?
Yes, absolutely.
To my mind, reading financial statements is a sort of essential skill in investing. So there are online courses that you can use. There are books available if you want to do it the professional way, become a chartered accountant, or do the CFA qualification, the American CFA qualification. A good grounding in and reading annual reports is essential. Now, you might say, look, I'm interested in reading annual reports, but I really don't have the time to go and do a CA or a CFA. In which case, if you take our book Diamonds in the Dust, in the first 150 pages, we've given you a simple way to at least get the basics of an annual report squeezed out. So for example, what are the basic things you should look for in an annual report? We've explained in Diamonds in the Dust. For example, you should always read the auditor's disclaimer. I've explained in the book where you can find the auditor's disclaimer, what exactly you should look for in the auditor's disclaimer. The auditor's disclaimer is plain English. You just have to read it and understand what the fellow is saying. Look at the composition of the board. If the board is the promoter G's, brother, sister, cousin, uncle, golf club buddy, right, and nobody else, then obviously it's a red flag. Right? Thirdly, there's a bunch of things straightforward things to look for on the cash flow statement, right? For example, you should look for example, operating cash flow plus investing cash flow. On the face of the cash flow statement, you can see operating cash flow, you can see investing cash flow. Add the two numbers up. The combination of the two should be above zero, right? So there are some basic tips for reading annual reports that we've tried to provide in Diamonds in the Dust. That you can go about. That's a shortcut. Ideal courses like CSE accounts, that is the least you should do if you're investing your own hard-earned money.
Right. Thanks so much for that. So shall we go to the next question?
Yes, please.
So next question is from Vikram, and he has asked how to calculate intrinsic value of any stock. So would you like to add anything to that?
I just told you, don't kill yourself doing that. It's not. You can do that if you want, but it's not gonna make you rich. There are people who spend their whole lives doing that and they still don't make money. I gave you a simpler way to think about that, which is figure out the length of time. Figure out the length of time in number of years. How long can the status quo sustain? How long can a successful company continue being successful, right? And in Diamonds in the Dust, there's a certain set of techniques we've given you for assessing this. I summarized those techniques using Titan as an example. I explained to you how the longevity framework works. I explained to you how to look for the drive, the determination of a company to constantly improve itself. I explained how succession planning becomes a critical driver for how long a company will be successful. Um, if you want to learn intrinsic valuation, DCF valuation, again, CFA, the CFA, US CFA course is very good. There are obviously several master's level programs in finance you can go on. And again, back to the internet, there are so many internet courses on intrinsic value, guys. If you're really interested in, go for that. But my experience of investing has been that killing yourself learning intrinsic value actually doesn't get you very far.
Right. Thanks so much for that. The next question is from Mohit, and Mohit has asked view on a specific company, Home First Finance Company. So, would you like to take such questions, or like again, shall we skip that?
No, Mohit. Ask your stockbroker. No, Mohit. Why are you asking me? Ask your stockbroker for stock tips. The stockbroker is qualified and paid to give you stock tips. I'm not here to give you stock tips.
Absolutely. So next question is from Gaurav, and he has asked like to explain the capital allocation part again, because that's where actually.
Okay, so let me explain it using a simpler example, right? So assume In our house, there's myself running a small business, Marcellus. There's another person in our house who runs a small business. She's my daughter. She's 12 years old. So she bakes cakes, and she's right. So just to keep it very simple, so assume my daughter sells 2 brownies at the school gate every morning. The brownies cost her around 30 rupees to make, and she sells each brownie for 50 rupees, right? So her cost is 60, her daily revenues are 100, and therefore every day she makes a 40 rupees ka profit. And therefore, at the end of the week, on a Friday evening, if I meet my daughter's made 40 rupees over 5 days. She's got 200 rupees profit from the week, right? So over the weekend, my daughter has to decide how to spend that 200 rupees. So the capital allocation she has to do is, should she invest the 200 rupees in, say, a cookbook that she can buy on Amazon on how to make amazing brownies and tarts and cakes? Should she spend the 200 rupees on she and her friends going and having ice creams at the local ice cream parlor, or should she put that 200 rupees in a piggy bank, right? This is exactly what everybody from Warren Buffett through to yours truly has to do, right? We call it we give it grandiose names, but fundamentally the job of a promoter is to make the same call that my daughter makes every Friday evening or every Saturday morning, that I have earned 200 rupiah over the week. That's my profit, that's my cash flow, so to speak. What will I do with this 200 rupiah, right? Do I do capex? Capex is a book for her on Amazon, a book purchased. Do I put it in the balance sheet, save it for a rainy day? That's her piggy bank. Or do I do OPEX, which in her case is go and have some ice cream, right? And this is the job of a promoter. This is a bloody hard job. It's hard for my daughter, it's hard for me, and it's hard for Warren Buffett. Very few promoters in the history of mankind are able to do this job well enough for their business to have a return on capital above 15%. And that's what separates the men from the boys, the women from the girls.
Right. Right. So next question is from Prasad, and Prasad has asked, when you mention like cash flow, so does that mean free net cash flow or like operative cash flow? So he's asking about the free cash flow.
Yeah, so we're discussing free cash flow, Prasad. Good question. So operating cash flow is basically the operating surplus from the P&L, right? Then from that you subtract the capex, subtract the building of new plants, the maintenance of the current plants, current factories, the building of new factories, right? So operating cash flow less investing cash flow is equal to free cash flow, right? So the sign of a successful company is consistent generation of free cash flows. No more than 30 companies in India, no more than 30 companies in the entire. It's a simple insight. Look for companies with free cash flow, and then look for companies who can grow free cash flow. But that simple insight has eluded most investors in the Indian market for the last several decades.
Right. Right. Thank you. So the next question is from Victor, and Victor actually has asked a question. I mean, he has asked this quite a few times during the chat. So he says that, what is the best way to invest as a student? So would you like to take him? He's a student, very enthusiastic.
Look,
So
I
would you
mean,
like to take
two
that
ways to
question?
do it, Victor. I mean, if you want to understand the power of compounding, invest in a tracker fund. So invest in a tracker fund, and you'll see that even a Nifty tracker held over 3, 4, 5, 6 years. Whatever equities you invest in, hold it for at least 3 years, folks. Less than 3 years, you can't hope to make money in India. So if you just want to understand the power of equity compounding for yourself, then start with a Nifty tracker. It's low cost, and just holding it for 3, 4 years will show you how powerful compounding is in terms of generating your wealth. That's how I started out my investing journey 20 years ago. If you want to teach yourself how to analyze stocks and invest in it, then at least do a CA, CFA, or at least do an online course in investing. Teach yourself the basics of investing using whatever you've learned. Identify a dozen odd stocks which, as per your learning, are high quality. Invest in them and then watch them for 3 years. Watch what happens to those stocks, a dozen odd high quality stocks that you've invested in. Watch what happens over at least 3 years, and see how that journey feels like. That if you really want to teach yourself bottom-up stock investing, that's probably the simplest way to go about it. But what you shouldn't do is this whole tips ka business. A lot of people have this crazy thing. They are on WhatsApp and on social media, वहाँ से tips लेके invest करते हैं. That to me is a little crazy. I don't know why people do it, but if you're doing it, don't do that. That doesn't make you any money.
Absolutely. Absolutely. So Sunil has a question. He says, how much does non-quantitative factors matter, and what do you look at?
I explained no again. So we look at the moat. You quantify them. You quantify the moat in terms of the price premium that the company charges relative to competition. Second thing you look at is the drive, the determination, the efforts that the company is making to constantly strengthen the business, deepen the moat, launch new products, disrupt the competition. And thirdly, you look at succession planning, right? Is the company consistently hiring, training, mentoring high quality to eventually become the C-suite, the CEOs of the company, right? Diamonds in the Dust, second half of the book will give you enough and more color on this subject.
Right. Abhijit has a question. The next question is from Abhijit, and he asked, like, what are the assumptions behind scoring? I mean, would you like to delve on this question a little bit?
Buy the book, read the book. So a lot of questions that people are asking, the answers are in my books. The books are easily available. I hope you buy the genuine version, but even if you buy the pirated version, you will learn. You cannot get anywhere in finance without reading, right? So if you want to become an investor, then whilst I'm really happy you guys have logged in, and IIQF has arranged this, so thanks to IIQF for making this session happen. But honestly, the way ahead is spend every evening reading. I think through my 20s, whether I like it or not, through my 20s I barely had any evening where I either wasn't studying or reading. It was a tough 20s. Most evenings I used to just fall asleep on my books and on my reading, but that's how your 20s have to be. If you're spending your 20s watching a lot of videos on YouTube, it's not bad, but I'm not so sure that's the best way to learn. So almost all these questions that have been asked, good questions, folks, but the answers are in Unusual Billionaires and Diamonds in the Dust. Buy the books, read them, and read high quality books on finance. You'll learn plenty, and if you do that for at least 4-5 years of solid reading, you'll make a lot of progress.
Absolutely. Absolutely. So again, going to the next question, it's from Piyush, and Piyush asks, actually, I'll take two questions together from Piyush and Sanit. Piyush asks, how do we detect accounting fraud in financial companies? And Sanit asks, easiest way to catch fraud in financial statement. So I just combined these two questions since, like, so for the paucity of time. So yes, those are the two questions. Would you like to?
Questions are completely different. No? So in financial companies, again, Diamonds in the Dust has an entire chapter, folks. Please read the book, right? You guys are curious, which is great to see, but you're not reading the right books. Diamonds in the Dust has an entire chapter on fraud in financial services companies, with 4 case studies of fraud in financial services companies and how we detected it. For example, a straightforward ratio which will help you assess fraud in financial services companies is if the NPA as a percentage of the loan book is consistently lower than the peer group, that raises questions about the recognition of NPAs. Right. Secondly, if a company is raising, if a lending company, if a bank or an NBFC is raising fresh capital when the balance sheet is suggesting that it already has excess capital, that's also a dead giveaway, right? So Diamonds in the Dust has an entire chapter devoted to fraud in lending companies in India and how you can detect the same. Fraud in non-lending companies, I discussed techniques, I gave you half a dozen ratios, and as I said, the first 150 pages of Diamonds in the Dust talks about accounting fraud ratios such as the cash conversion ratio, CFO to EBITDA, why the cash conversion ratio will give you a good indication of which company is cooking the books in an industry.
Absolutely. Right. So the next question is from Prasenjit, and he has like couple of questions actually who has put together. So he asks, how do you decide to sell a stock from your portfolio? And the second question is, how important are the valuation multiples?
So we decide to sell on the reverse of what we decide to buy on. As I said, we buy stocks when the books are clean, when capital allocation is good, and when the franchise has a moat, right? And therefore we sell naturally when any one of these conditions are compromised. So if we spot fraud, that's time to exit. If we spot capital allocation going awry, capital allocation deteriorating, that's time to exit. And thirdly, if we spot that the moat is eroding, then that's time to exit. Valuation has no role to play. I've never understood how people decide that it's now expensive and I'll sell this stock. It hasn't made any sense to me. It's like you might as well say that today it rained, so I've decided to sell the stock because rainfall is bad for this business. It's sort of pseudoscience to say I sold the stock because the valuation looked rich to me.
Right. Absolutely. So next question is from Mahindra, and he says, "What is the okay?" So I mean, this is like a question that few people have asked. So I'm just putting it. I mean, if you are comfortable answering, then only you should. You can answer. Otherwise, we can go to the next question. So a couple of them have asked, "What is the criteria for investing in Marcellus funds?" And Ajay has asked. As an NRI, how to start investing with Marcellus? I'm not sure whether you want to take this question or not, but yeah. I mean,
So there is no criteria, folks. I mean, we are a SEBI-regulated PMS. So whether you're an NRI or you're a resident in India, as per SEBI's rules, the minimum corpus is 50 lakhs. If you want to invest in Marcellus, sales at marcellus.in, sales, S-A-L-E-S, sales plural, S-A-L-E-S at marcellus.in. Just drop them a mail and they'll help you, they'll guide you through the process. But the SEBI criteria is minimum 50 lakhs is the corpus required to become a PMS investor. And same for the process is same for locals and NRIs. Is a couple of extra steps for NRIs, but if you drop a mail to sales at marcellus.in, they'll take you through that.
correct. Wonderful. Okay. So I hope everyone can took a note of those, particularly those who asked the question on how to invest in Marcellus. Going to the next question. So this is from Abhishek, and Abhishek has asked how to know the company that is investing their capital in the company itself. What parameters we have to see?
So you just read the annual report, right? If you read the annual report, you'll firstly in the management discussion and analysis part, the company will explain how much capital they've invested, what have they invested the capital in. So the company will say that, for example, we spent 150 crores setting up a plant in wherever, Dahej or Pune or wherever, right? So the management will say so. And the second is you look at the balance sheet and you look at property, plant, and equipment. And if that number is rising year upon year upon year, you can see that the company is investing in factories, property, plant, and equipment basically is factories and machines. And if you can see that the company is investing in machinery, you know that the company is taking the cash flows and putting it back to work. If you want to look at the cash flow statement under investing cash flow measures the amount of investment that the company has done on the business. So again, reading accounts, folks, learn to read accounts. If you can't read accounts, that's the language of finance. It's like saying, I want to live in Kolkata, but I won't learn Bengali.
Right. So the next question is from Sanit, and Sanit says, if the company's asset is decreasing and free cash flow is increasing, what it means? Any fraud is an indication of fraud? So that's his question.
I mean, in any company, the way accounting rules work is the company has to depreciate its fixed assets. Typically, a company which is growing revenues, growing profits, growing cash flows, typically they have to increase their assets to grow the business. However, you can have companies, for example, a brokerage business doesn't necessarily have to have growing assets, right? Or take a business like Marcellus, right? Our assets are what? Our assets are this, my laptop, my colleagues' laptop, and that's pretty much it. We have no other assets. Now, as per accounting convention, we have to depreciate all our laptops. I think it's a 5-year. We have to depreciate the laptops over 5 years. So every year our assets are 20% less than the year before. But as our business continues to grow, our business continues to grow because more and more of you are giving us your money to manage, and therefore our revenues are growing, our profits are growing, our cash flows are growing, but our assets are going down. So you could have a services business, a professional services business like a brokerage or an asset manager or an IT services company, where free cash flows are growing but fixed assets are coming down. But if in a manufacturing business, if in a manufacturing business free cash flows are growing, and on the balance sheet you can see the assets are coming down, that will be indeed very, very perplexing.
Right, absolutely. So Kapil has requested, that's the next question is from Kapil. So he has requested to mention the names of the books once again. Would you like to do that?
I'll repeat again. So the easiest book for someone who's starting out in investing, the easiest book is, if you read Gurus of Chaos, that's a bunch of interviews with my gurus, the people who taught me investing. So Gurus of Chaos was published in 2014, and that's the easiest of my books to read. If you want to understand how great companies build monopolies, how great promoters build monopolies and kill the competition, then read the 2016 book, which is called The Unusual Billionaires. Right? If you want to learn how to allocate your personal finance portfolio, right? You want to figure out what do I do for a rainy day, how to build my equity portfolio, then read Coffee Can Investing. The 2018 book is called Coffee Can Investing. And finally, if you want to learn how to invest money, right? Most of these questions you guys are asking pertain to investing your own money in the stock market, then read the 2021 book, Diamonds in the Dust, right? Easiest thing to do is go to Amazon, stick my name in Amazon, and all the books will come up. It's very easy. Amazon.in, put my name in Amazon.in, all the books will come up. And I think Amazon gives you various offers. If you buy 3 books together, you get a discount. And if you don't want to buy them on Amazon, then I think on every footpath in the country, my books are sold pirated. So if you want to buy the pirated versions, go to the nearest footpath bookseller and he'll have them available.
Right. The next question is from P. Biswas, and he says, how important are the market-wide factors while investing?
So Nitish, I'll take this and one more, and then I'll call it a day, because otherwise,
yes, of course. I mean, anyway, I would have also. I mean, it's like
so
2 more
market
questions.
Market-wide factors are utterly irrelevant. So market-wide factors don't matter whether whatever Nancy Pelosi is doing or whatever the Chinese government is doing, whatever is the latest from Vladimir Putin, whatever is Joe Biden's COVID status, whatever is Federal Reserve's announcement or the RBI's announcement or the union budget announcement or the latest PE multiple of the Nifty. All of these are useless things. They have no bearing on how you should invest money. This sort of thing is like when so if you go to a family wedding, right, you'll notice there'll be plenty of gossip discussed, right? Whose son has got into which university, whose daughter is become friends with whom, right? All of this stuff is kind of family gossip, but none of that is useful. We do that because it builds camaraderie, it builds social spirit. So this sort of gossip, Fed ne kya kiya, market ne kya kiya, is also market gossip. This is what people in the market do to pass their time. If you guys get locked into that, a lifetime of time wasting awaits you. What was the next question, Nitish?
Next question is from Kusagra, and he has asked, do sector rotation also include in your part of entry and exit?
No, another craziness. So I heard this before. Some people tell me, "Abhi IT acha lagta hai." I read some other guy said on one of the financial websites, I think the next few years, next 10 years looks great for banks. Some other person will opine, abhi metals ke liye abhi rally chalu hoga. This is also kind of bonkers sort of attitude to finance, right? I don't understand how this is of any use. This is only a little bit better. So once I met an investor, so he is actually a family friend ka relative. He called me to his office. So I explained to you guys what we do, right? Clean accounts, good capital, modes. So this guy said to me that at the moment, He said to me in all seriousness, I'm not making this up, wealthy Bombay businessman. He said to me, at the moment, the planets are aligned as they were aligned during the Ketan Parekh scam. So therefore, I'll not invest. So I said, that's fine. I said, do you want me to come back? He says, as per my astrologer, a year hence, the planets will move to a different position. A year hence, we will contemplate investing in Marcellus consistent compounders. So I said, that's fine. And I left. Right? What can I do? I mean, if your astrologer has told you planets are aligned like Ketan Parekh scam, then obviously you shouldn't invest. What happened was the subsequent week, the finance minister cut the tax rate by 10%. So most companies in India don't actually make that much profit. So the tax cut didn't really matter for them. But the companies we invest in, they make tons of profit. So if you cut the tax rate from 35 to 25, right, basic math suggests the value of the company goes up 10%. So overnight, our stocks went up 10%. So this guy called up. He said, "Tumne bola nahi, कि tax cut hoga." So I said, first, I didn't know, I didn't know tax cut hoga. But you only said no, Ketan Parekh scam, planets aligned. So kya kare, right? So he said, nahi, abhi dalne ka hai kya? So I said, you check with your astrologer. No. So you check with your astrologer whether this is the time to invest. This whole sector rotation stuff is of that ilk. You might as well check with your astrologer rather than looking at sector rotation.
Right. So can we take one more question?
Anybody who gives you this sort of advice, what you can do is just have a psychiatrist number to hand and tell that person, दिमाग का checkup करा दीजिए, ये number है, दिमाग का checkup का time आ गया है. So Nitish, I think we'll call it a day here. Very kind of you guys to host us, and thank you to all of your attendees. I think there's 106 people who have basically spent their valuable evening listening to me chattering. Thank you to all of you.
Thank you so much for joining, Saurabh. It was a real pleasure hearing you once again. We have heard you so many times. So thank you for giving your time for this webinar where our participants also got a chance to hear you. There is one more question which I will take up very briefly, but yes.
Finish it off.
Sure. Thank you. So before we call it a day, I mean, there is one question that Cyril has asked a couple of times, and Cyril, he has asked like how, I mean, he has not had maths and all in his like +2. He wants to do CFA. Cyril, since you have asked that so many times, so again, I believe that is something you may reach out to me also. I can explain how you can go about it. Right. So
this is the right person to guide you on that, Cyril.
No. Anyway, so I mean, I'll provide my contact details, Cyril, to you, and again, you can get in touch with me, and we can discuss on that. But I mean, once again, thank you so much, Saurabh. So we will call it a day with that, and look forward to hear you many more times. Thank you.
Thank you, sir. Bye for now.